The Fox City Score chapter and WHBY are pleased to bring you Biz Talk, a chance for you to hear from entrepreneurs and professionals as they share their experiences from starting to sustaining growth. Learn the skills needed for your business to be successful. If you missed anything, you can catch the Biz Talk podcast at biztalkwithscore.com. And now from the Myron Construction Studio, it's Biz Talk on WHBY.
Good morning and welcome to Biz Talk with Score. This is our last show of 2024. We will be on break for a couple weeks after this and coming back into the new year. And we're really happy to be joined by Pat Lowney once again, a former regular host who's now a regular guest host, helping to fill in for our Rick Sense. We really appreciate that. So Pat, how are you doing?
I'm doing good. Good to be here, Terry.
Good. And our guest is a longtime sponsor and a regular guest on the show. It's Kurt Heling from Heling and Associates. And Kurt, how are you today?
Doing great. Good to be on the show again.
Good. Okay. So as we get started, everybody listening has heard Kurt and knows Kurt runs his own accounting and tax business. We're going to talk a lot of different aspects of tax planning, working on 2024, and also some other issues that you really need to be aware of. So let's get started. We're going to talk first about tax planning for 2024. And Kurt, what should a business owner especially coming in to see you be preparing for when they have that conversation?
Well, we're meeting with a lot of business owners right now this time of the year regarding tax planning. And the first thing that we need to see is, are the books up to date? You know, if you're coming to see us in December and you haven't reconciled your checkbook since June, there's a pretty good chance that there's a lot of information in there that either is inaccurate or is omitted. And so it's hard to give good advice when we're not dealing with up-to-date information. So that would be the first thing I would say is that you need to have your books up to date and, you know, checkbooks reconciled, credit cards reconciled, and have that they don't need to be perfect, but at least something that we can work off that's up to date and relatively accurate. At that point, then we take a look at, you know, the business owner's profit year to date through, say, October, November, and get an idea of what they're looking at for the year. One of the things that often isn't factored into that is things like depreciation. And with depreciation, just to give a little bit of background, is where you buy assets, whether it's truck, equipment, office furniture, whatever it might be, and you, according to IRS, have to depreciate over a specific period of time, whether it's 5 years, 7 years, you know, it could be as long as 39 years for a building. And with those assets, sometimes we're allowed to write those off all in 1 year. And there's two ways that we can do that. One is called Section 179, and that's been around forever. Or there's bonus depreciation. The good and the bad with bonus depreciation is you can take that first year write-off even if the company is not profitable, although oftentimes we don't like to do it that way. And the second thing is, on the downside is, number one, the state doesn't follow it, and number two, the bonus depreciation is down to 40% this year. So as opposed to being 100% in previous years, you know, and it kind of had a sliding scale of 80 and 60 this last year. So with that, we're not getting the full write-off that we do with Section 179. So typically we'll take the 179 write-off, which allows us to take the entire expense up front in most cases on those assets, unless it's real estate. So we look at that and get the depreciation factored and get a good idea where the business owner is sitting from a profit standpoint, and then project out what the tax impact's going to be, and then take a look at, are they covered? Have they paid enough in quarterly estimates? Do they have enough withholding off their payroll checks to cover it? Do they need to could they put more into a retirement plan through the business if they wanted to? Those are all sorts of things that come into play as we're looking at these things at year end. After we get through the end of the year, there's not a whole lot we can do to bring that profit down for the rest of the year. So having that upfront meeting, we can get together and say, hey, if you were thinking about buying a truck for the business, go do it before the end of the year versus after the end of the year, because you need to buy it, you need to have it in place. You don't necessarily have to pay for it. You can finance it, but you do need to take possession of it and have it in service before the end of the year in order to get that. And we can be talking thousands of dollars worth of deductions in these cases.
Do you also then have discussions around what sort of bonuses they should pay and when?
Oh, absolutely, yes. Couple of different types of bonuses. The employee bonuses, if they have employees, and how much they're planning to do that way. Not necessarily by employee, but collectively, how much are they planning to give to the staff? And then secondly, how much they should take as a bonus. And with that bonus, maxing out the retirement plan, making sure they've got enough withholding that they're covered for the entire year, so they're not writing huge checks on April 15th. And the other thing is, for instance, with our S corporations, making sure that they have what's called a reasonable wage, so that it doesn't fall subject to IRS scrutiny as well.
Okay. So let's switch over to individuals now, because I know there's a lot of complexities there too. So what should individuals be doing as they come into December and looking at year end?
Well, some of the things that individuals can do, from the tax planning standpoint, is if they have IRAs out there, for instance, they can convert those IRAs to Roth IRAs. And a lot of times what we'll do with our individual clients is say, okay, let's max out the 12% bracket or the 22% bracket doing a Roth conversion. And in doing that, we convert a traditional IRA to a Roth IRA, pay the tax now, and they have to have the tax money outside of that IRA. They can't use the IRA money to pay the tax. And when we do that, then that Roth conversion money grows tax-free until retirement time when they're able to take it out. A couple of things we have to watch out for is if it's a situation where, for instance, the person is on marketplace health insurance, we may not want to do a Roth conversion because that may make their health insurance premiums higher than what they signed up for at the beginning of the year. And in that situation, we kind of become accountant/insurance agent because we have to watch how much their insurance premiums are going to be as well. So there's a lot of moving parts with some of these things from a planning standpoint. So sometimes you'll see people try and do these things on their own, and then all of a sudden they run into a snag because, they did a Roth conversion. Now all of a sudden they owe an extra $4,000 in taxes because it messed up their health insurance that they signed up for at the beginning of the year, saying, well, my own income is only going to be X. Well, now it's X plus the amount that you converted for Roth. You didn't actually get that money, but it shows up on your tax return as taxable income, and so it affects the health insurance. So there's different moving parts that way.
Okay. So another topic I've heard a lot about recently is required minimum distributions from IRAs.
Sure.
Let's talk about that a little bit.
So required minimum distributions come into play. There's been some changes with that in the last couple of years. It used to be for many, many years, you were required to take minimum distributions starting at age 70 and a half. Now you can start at age 73, so they backed it up a couple of years, and take your required minimum distributions. And what that means with required minimum distributions is that's the amount that you're required to take out of an IRA account once you hit that magic age of 73. And it's an actuarial computation based on life expectancy. They will tell you how much you need to take out based on the previous year's value. So the IRA custodian has those amounts computed. And then out of there, you want to make sure you have federal and state withholding, obviously. One thing that is available to those that are 70 and a half, and this age didn't change with the other rule, is as part of your required minimum distribution, a person can make what's called a qualified charitable donation. And what that means is you can take money from your IRA and have it go directly to a church or whatever organization, charitable organization you want. You can't get the funds. The check's got to be made out from the IRA custodian to the charitable organization. that distribution, but it is not taxable. So that's something that we really stress with our people that are in their 70s that make donations, because with today's tax rules, the standard deduction is going to be almost $32,000 for those that are over 65. Those people are more often than not going to be itemizing. They're not going to get any benefit from making that charitable donation unless they do it through their IRA and use this qualified charitable donation and make it directly through the IRA.
And Kurt, can that be even for a small donation, like $1,000 or $500 or something?
It can. Different custodians have different minimums. There's no IRS minimum, but
Okay.
the custodian is handling it. So, for instance, they don't want to deal with $20 going into the church plate every week.
Yeah.
So they may have a $250 minimum or a $500 minimum, but that's strictly the custodian's protocol. That's not anything specific with IRS.
So anybody making taxable or charitable contributions who's getting RMDs should be working with their accountant to make sure they're paying that directly out of their IRA to the recipient.
Right. They should be working with their accountant. They should be working with their investment advisor too.
Okay.
So, Kurt, I've got a question. Is there a point in life, age or income that a couple might be making that they should be thinking about talking to someone like you to help them do the planning part of this versus, using TurboTax or some, cheaper method that they're doing just to get the taxes done?
I would say early on even, because a lot of times you'll see even young couples, they'll try and do TurboTax and they run into situations with, dependents and, if they've got dependents from a previous marriage and who claims which dependent, and then you get daycare involved and there's daycare credits that get involved and you have to make sure you complete those forms correctly. For the state, there's private school tuition, there's tuition deductions that way, there's 529 plans for people. I mean, you could go through any age bracket and find reasons that people should be talking with a tax professional.
And one other comment too is I've heard a lot recently in the last year or so about health savings accounts and people starting to use those as investments for the future. Is that something similar to IRAs too?
I'll say similar but different. And the reason I say that is the similarities are in that it's a pre-tax contribution that you can make, just like an IRA, and it goes into an account, and you can use that account for any medical, anything that would normally be considered a medical deduction. Okay. So really what's happening is when you make that contribution, that IRA, you're getting your medical deduction up front. And then you pay your medical expenses along the way through that HSA. Now, if you don't have a lot of medical expenses, but you maximize the contribution going into these HSAs, and it's $8,300, for instance, for a married couple, and you've only got a couple $1,000s worth of medical expenses, you can invest that. And there are custodians out there that will allow you to invest it in mutual funds or however you want to invest it and get some growth on it, so that's not sitting in a bank account making, 0.25% or something like that. So you can leverage that a little bit. Again, it's one of those things, just because you can do it doesn't always mean you should, because once you invest that, you're at the risk of the market. So it can go up or down. So you want to have at least a nest egg of that in a very safe, secure account to cover medical expenses. But then if you end up having a balance of $20,000, $30,000 in there, by all means, invest some of that and get some return on it. Then when you get to age 65, you're no longer able to contribute to the HSA. And otherwise, up to age 65, as long as you have a qualifying health insurance plan. And that's key, because I've had some people keep contributing and their health insurance isn't a qualifying plan. So you need to talk with your insurance person to make sure that you've got a qualifying plan for the HSA. And assuming you are, you can contribute right up to age 65. Once you hit 65, you can't contribute, but you can still use the balance in that account for medical expenses, even into retirement.
Okay. We're at the right place for our first break. You're listening to Biz Talk with Score on WHBY, and we'll be right back after these messages.
Welcome back. We're glad you joined us this morning. Our guest this morning is Kurt Heling with Heling & Associates CPAs. And before we continue our conversation with Kurt, I'd like to tell you about SCORE Northeast Wisconsin. SCORE Northeast Wisconsin serves an 18-county area in Northeast Wisconsin, plus the county of Menominee and Michigan. We have 50 volunteers, each an expert in their field, offering entrepreneurs no cost and confidential mentoring. Those areas of expertise include IT, social media, marketing, cash flow, accounting, strategic planning, workflow, HR, retail, best practices, and many others. To register for a no-cost confidential mentoring session or to learn more about SCORE Northeast Wisconsin, visit our website at score.org/Northeast Wisconsin. You can learn more about how the SCORE chapter can assist you with starting and or growing your business. You complete an application on the website, and we'll get back to you. Simply complete the online form and submit it to SCORE. Within a few days, a SCORE mentor will be contacting you to set up a meeting. Remember, SCORE is no cost and offers experts who can offer you assistance in many different areas. To get started, visit our website at score.org/Northeast Wisconsin. And to support small business people, SCORE Northeast Wisconsin is always looking for new mentors. If you have experience that you'd like to share with others, we'd love to talk to you. We welcome volunteers with experience in all aspects of business. Small business owners need your help, and your experience can make a real difference in their success. Go to score.org, Northeast Wisconsin, click on the volunteer button, and fill out the short application. We'll get back to you to explain more. Now let's turn back to Kurt. So, Kurt, I guess one of the things we wanted to carry on from the last conversation was on inherited IRAs. So tell us about the rules that changed with if I inherit an IRA from my parents, for example.
Yeah. So what happens with IRAs when you are a what they call a non-spouse beneficiary. So basically, in most cases, that means the kids. The parents pass away, they have IRAs, and the kids inherit these IRAs. The rules now state that you're required to get that money out of the IRA in full within 10 years. And in addition to that, if the parents were to the point of having to take required minimum distributions themselves, then those beneficiaries have to continue minimum distributions. They can't just leave the money in the IRA all the way through the end of year 10 and then take it out at, the 364th day of that year. They have to take minimum distributions in each of those years from the IRAs. So that's something that a lot of beneficiaries are surprised at when they find that out, because they may inherit this money and they say, well, okay, now what do we do with it? Well, you can take it out, but you're going to pay tax on it. Well, I don't want to take it out then. I just want to let it grow. Well, the IRS, the government and the IRS want to get this money back into circulation. So that's why they changed this rule. And they changed this rule about 5 years ago. And that's why they want to get this money back into circulation. So even Roth IRAs need to be liquidated within 10 years. The key with Roth IRAs, because they're not subject to a required minimum distribution, you can leave those grow the whole 10 years and take them out at the end of in the very last year. And with the Roth IRA, I would encourage you to do that if you can. It doesn't come out taxable, just like Roth IRAs normally are not taxable when you take them out, but they want to get that money back into circulation. So think about it. The parents die in their 80s, for instance. The kids that inherit this are in their 50s and 60s. They're probably at their highest earning years before they retire, right? Now they're going to inherit this money through these IRAs and have to take out the minimum distributions and have to clean those out within 10 years. You're putting that on top of their highest earning years. That's where the money grab is, because you're putting that on top of this other money that they're earning. That may push them from a 24% bracket into a 32% bracket or whatever the brackets are going to be at that point. That's where the money grab is.
And that's why you should be thinking and planning for this, right? You need to. It isn't just something you inherited and you set it on a shelf, forget about it.
Well, exactly. That's why we plan for it. And that's why you might see somebody in their 70s or 80s doing Roth conversions, even though they're not necessarily going to see the benefit of it, because of their age, but it helps the kids out when they inherit it.
Are you seeing more of that, Kurt, that people are doing that?
We're seeing that happen. And the other thing that we're seeing happen is we're seeing the kids take out life insurance on their parents that might be in their 70s or 80s, because when the parents pass away, then the kids have these life insurance policies that they can get the benefit from. And when they get the life insurance benefit, they can use that to pay the tax on the IRA. And I said, my wife is a medical underwriter. She said with an insurance company, and so she works with the underwriters. And she says, why are these people in their 70s and 80s getting these life insurance policies? And that's the reason why they're getting these life insurance policies. It's usually the kids that are buying the policies on the parents, and then they're the beneficiaries to pay the tax on the IRAs.
Yeah. It's always amazing to see the unintended consequences of tax changes and watch how it impacts people. So we are at the right spot for our next break. You're listening to Biz Talk with Score on WHBY, and we'll be right back. Welcome back to Biz Talk with Score. This week we're talking to longtime sponsor Kurt Heling. Before we get back to Kurt, I have a couple of educational opportunities to mention to you. As you know, if you go to our website, score.northeastwisconsin and .org, and you look at up in the top bar, and you'll see a workshops and events tab. If you go in there, there's a lot of different webinars that are coming up, hundreds of them, in fact. But there's two I want to mention that may be of interest. The first one is called Loans, Grants, and Other Funding Options for Small Business. That's on December 17th at 12 o'clock Central. That's free if you go in and sign up. But it's a good opportunity to learn more about how you can fund your business, especially some of the new ways that have come up in the last few years. The other one I wanted to mention is using key performance indicators for success. So we always want people to understand their cash flow and make sure they can explain and manage cash flow. But one of the things that helps you do that is having key performance indicators that identify where your business opportunities and successes or issues are coming from. So this is called Using Key Performance Indicators for Success, and that's December 16th at 6:30 p.m. Central Time. So with that, we'll get back to Kurt. And Kurt, one of the most, controversial and unique things that have happened in the last few years is the passing of the beneficial ownership information rule. And there's been some changes with that. Can you talk about that with us?
Yeah. So to give a little bit of background, the beneficial ownership information rule was passed a couple of years back, and it came into effect in 2024. And the reason behind it is they being the Department of Treasury wanted to get an understanding of who owned all these LLCs that are being formed, whether they're people within the U.S., outside the U.S. You've got LLCs that are being owned by other LLCs. They're being owned by other LLCs. They're trying to get their hands on who are the actual individuals that are what they call the beneficial owners. The primary owners are the people that have management behind them. So they passed the beneficial ownership information rule, and what was supposed to happen is you were supposed to go to the FinCEN website, FINCEN. And what FinCEN stands for is the Financial Crimes Enforcement Network. So it's the guys with the guns with the Department of Treasury. So this is a big deal. And again, a lot of this has to do with international money laundering and things like that they're trying to get their arms around. So in doing so, they were requiring every small business that was organized as an LLC, an S Corp, pretty much anything, a limited liability partnership, any of those entities that were not considered a public entity or were not a qualifying size, they already know who ran the big guys, the big companies, and who are the owners of these other companies. They already know who Elon Musk is and Jeff Bezos. They got that. They're trying to find the smaller companies and who the beneficial owners are there. So people would look at this and say, well, I'm just a little company. This doesn't apply to me. That's exactly who it applied to. So you're supposed to go to the FinCEN website and complete this beneficial ownership form, upload your personal information, your driver's license, things of that nature. And as of a month ago, I was at a seminar. They estimated 32 million entities within the United States that were supposed to register. At that point in time, only 6 million had. They were 26 million short. And the instructor said, can you imagine what's going to happen to those computer systems when everybody starts registering in December? They're going to crash. Well, that's not necessarily what happened. What happened was about a week or so ago, the first week of December, there was a federal court down in Texas that issued a temporary injunction against the BOI registration. So what that means is it's getting appealed, it's going through the court process, and right now, if you were to go to the FinCEN website to register, there is on the website, it says it is a voluntary information disclosure, not a requirement. The reason it was a big deal and you know, the type of thing where it caused some anxiety, it was $591 a day if you didn't have this registered by December 31st, 2024. So that adds up really quickly, $591 a day. They were serious about it. I don't know how they were going to enforce it. That's a whole nother issue. But as far as the actual implementation of it, that has been curtailed right now. It's in the court system. And obviously people are bringing up situations of privacy of information and all these other things. I've still been advising people, there's no harm in doing it. If you don't have anything to hide, there's no reason not to put the information on there. But at the same time, if you're not comfortable giving the government that information, at this point, you don't have to do it. And I just literally, during our break, got an email from somebody that we work with pretty closely on this who has what I would call a corporate records management company, sends me over an email from Forbes with the headline, with the deadline looming, FinCEN's beneficial ownership information reporting is a hot mess. And that's about as descriptive as you could put it.
So with the efforts of court, and they were pretty harsh on this law, but whatever they say, the fact of the matter is that the government probably wasn't ready to implement this anyhow.
No, I don't think they really were, because again, there wasn't as much information out there as there should have been to get people doing this throughout the year, which is why there was such a shortfall even, a month or 6 weeks ago. Their computer systems weren't going to be able to handle it. I don't know that they had any system in place to implement these fines, or if they were just going to be on the back end. If they found somebody doing some money laundering, this would be something they would throw on top of it. I don't know what the rationale or thought process was. That I can't tell you, but they were trying to. The key behind it is they're trying to get into this whole money laundering and who actually owns these businesses.
Okay.
So I got to throw my 2 cents in here. I thought when I finished my career in banking that I'd never hear of FinCEN again. And then here it comes.
Exactly.
That's exactly right.
All right. Let's turn to our last topic for the show this week. I want to talk about coming retirement for business owners. I know I've had several clients come and talk to us. I typically refer them to a professional because this is really complicated stuff and it can cost them a lot of money. But I know you are one of the professionals who do this and you're seeing quite a bit of it.
Yeah, it's interesting how things cycle around. This year, for whatever reason, has been kind of the year of the business sale or retirement for our business owners. I've got a half a dozen in 2024 alone, and a couple of sales that are going to be closing in early 2025. It's just one of those quirks, and I could speculate on the reasons behind it. We could do a full show just on things you need to worry about with transitioning out of your business. But one thing that you want to do, and again, this goes back to what I was talking about with respect to tax planning originally. You want to make sure your books are in good shape if you're talking with the buyer, because that's what they're going off of to make their decision, to make their offer to buy the business. So you want to have everything up to date. You want to have everything on the up and up in there also. And what I mean by that is if you're in a situation where you're taking a lot of cash out of the business, and it's not getting reported on a tax return, it's not getting reported on your financial statements, well, guess what? Nobody's going to pay you for what you're taking out of the business in cash. That it doesn't show up on a tax return, it doesn't show up on a financial statement. Nobody believes that's there. So you may be penny wise ahead by taking it out of the till, but on the back end, you may be hurting yourself even more when it comes time to try and sell the business.
Okay. And so when you are working with them on the accurate financials, is it something where you end up having to go back and restate a lot of financials, or are typically people in good shape?
Typically we don't try and restate a lot of financials because, again, you're dealing with a business owner on the other end that's coming in to buy this. And if things are getting restated, then there comes to be questions of, well, are they just doing this to make this look good for the sale? What was the problem in the past? So we try not to do a lot of that. But that doesn't mean that there aren't situations where maybe there was an oddball year where something happened that needs to get noted, in our disclosures when we're talking with the business owners. Maybe there was a lot of equipment sale one year, or there was an employee situation one year, or, these days when you're talking with buyers, you don't even look at 2020 because of COVID. You may not even look at 2021 because of COVID. Because those years were such anomalies to what a normal business year would be like for these business owners. So a lot more weight is going on to 2023, 24, 23, 22. Anything beyond that is almost like ancient history at this point. One of the things that we do look at with respect to this is some of the multipliers and what people look for as far as when they're buying a business. They may look at, it's not just what's the bottom line, what does it make, or what do you have in assets and what are they worth? But it's also the multiplier of the going concern. What's the business value worth? Not just the assets, but the going concern, the employees in place and the customer base. And one of the ways that you can help compute that is through what's called EBITDA. And EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And so there's a calculation that's done to compute that, and then there's a multiplier that can go on top of that. And that multiplier can vary by different industries. Some industries it can be, 5 times EBITDA. Other industries it's maybe 2 or 3 times EBITDA. So that's something that the business owner is going to research and want to find out through their trade associations or through advisors that have history working with sellers in those types of industries that give those variables. And a lot of times it's got to do with, how loyal is your customer base, for instance? How loyal are your employees? How often do you need to turn those over? Because that's what a buyer of the business is coming in for. They can go out and buy the assets a lot of times, but they want to buy the business, which includes the customer base, the employees, and come in and keep the thing running.
So ideally, working with somebody who's going to sell their business, how much time, how many years would you like them to be thinking about this before they actually do it?
At least two or three, because you can't. It's hard to come in the year before the sale and say, okay, I'm ready to sell now, and then almost, in some situations you're trying to put lipstick on a pig if the business hasn't been profitable in the past. So you want to be thinking about that ahead of time, and you want to think about that in with respect to some of the decisions you're making on a day-to-day, month-by-month, year-to-year basis. what are you going to replace? What do you need to have in place for a buyer? Are they going to want to buy something and you've got antiquated computer systems, for instance? Well, okay, now they're going to come in. The first thing they've got to do is put $20,000 into your computer system, from your accounting system to your point of sale to whatever else you might have. Well, okay, if they've got to put that money in, guess what? They're not going to give you that money for the sale. So, those are situations that can come up, and taking a look at the business and making sure that's dressed up and in good shape for a buyer.
And we've found too that when we're talking to people, they sometimes, almost always, seem to have a much higher estimate of what their business is worth initially than what it really is. Is that a good example or a good thing?
Absolutely. And that's driven in part by, in part by the owner's ego, number one, because they've built it up and it's their baby and they've been working it for how many years. And so it's worth that to them. But what's it worth to an outside party coming in to buy? There's got to be a reason for that outside party to want to buy it. Is there some sort of a synergy with another business that outside party has? Or is there a synergy, or is it a person that has some experience in that industry, and so they're leaving someplace and want to get into the ownership standpoint? So an outside party is going to look at much differently. Sometimes you have business sales that happen within families. Well, then you might get that dollar amount. But then you got to look at it and say, okay, how much am I going to charge my kids versus what I think the business is really worth? So you might think it's worth $5 million, but I'll give my kid a good deal. I'll sell it to him for $3 million. And the thing's really only worth $1.5 million anyway. Well, again, you haven't really done anybody any favors at that point. So it's, Pat, to your point before from the banking industry, it's got to work from a banking standpoint, from a cash flow standpoint, before anybody's going to actually give you that dollar amount. You may have situations where you sell it to internal employees. That can be a really good exit strategy, especially if you've trained those employees internally to the point where they can run the thing on their own and let you back away. Because then, in that situation, if you have a situation where they can run it and take and run with it, the payment to the bank basically replaces what your salary was as the owner. And so it can still work from that standpoint. And
as far as the income from selling that business, it's, I assume, typically capital gains that they're taxed on that gain, or is it other?
Well, it depends. I'll give you the standard accountant's answer. It depends. And the reason for that is, we talked about some of the accelerated depreciation things earlier in the show, like Section 179. If you've got accelerated depreciation in there, that there's an animal out there called depreciation recapture. That recapture is actually taxed at ordinary rates. So your 22, 24% brackets. But if you get it, the portion of the sale that's categorized to goodwill, or intangible assets, that's typically going to be at capital gain rates. And that's usually where the bulk of the value is anyway. But that recapture is something you do need to keep in the back of your mind and have your accountant run the numbers on that so you know the difference and get a good number on that.
So it goes back again, as if you're going to sell your business, talk to your accountant and get them involved to do this.
And do it before you sign a letter of intent.
So I've got a question. Goodwill. Do you see that often?
Yes, a lot. Or some variation of it, because the goodwill is designed to encapsulate the customer base, the employee base, the going concern of the business. So you do see that a lot because, the buyers can buy the assets of the business. They could buy it, they could go out and buy those assets off the street someplace, or they can buy them from you. But what they're really looking for is that going concern and being able to jump in and run with it. And so you do see goodwill a fair amount. And goodwill is some people use the term blue sky. It's an intangible asset. So that's where using those factors like EBITDA to come in and help compute that and put a value on that, it come into play.
Okay. We're at the point where we have to take our last break. You're listening to Biz Talk with Score on WHBY, and we will be right back. Welcome back. I would like to thank the sponsors and donors who bring Biz Talk with Score to you each weekend. We couldn't present Biz Talk without their generous support. Thank you to Kurt and Heling & Associates. Heling & Associates helps small businesses and individuals not just prepare tax returns, but plan ahead, helping you minimize taxes for this year or beyond. Heling & Associates, personal connection, positive results. Thank you to the Business News for promoting our program in the biweekly business newspaper serving Northeast Wisconsin. If you don't already subscribe to the Business News, you should. The paper is delivered biweekly and contains relevant and useful information about the business community in Northeast Wisconsin. We would also like to recognize the David L. and Rita E. Nelson Fund within the Community Foundation for the Fox Valley region for their generous donation in support of Biz Talk and Score Northeast Wisconsin. And I will mention again, we have a new sponsor coming on. Johnson Bank will be joining us as a sponsor in January, and we really appreciate their assistance as they help us with the radio show and podcast. So now we'll turn back to Kurt, and we'll talk a little bit more, go back to planning for the end of the year. So Kurt, as you think through the clients you have coming forward, what are the type of things you really want them to be asking you about and doing as they prepare to come in?
Well, we send out a lot of communications to our clients as far as things like checklists of information to get together at year end, and things that they need to worry about as far as, what they need to worry about for 1099s. We sent one out on the BOI before the injunction came through. Number one, read those. I was talking with somebody the other day. It says, remember that email I sent out? And he's like, yeah, no, I didn't read that. It's like, why do you think I bother sending those things out? So at least he was honest though, right? But we send these checklists out so that people can gather the information that we need to prepare the return. But even before that, even this time of the year, make sure the information's up to date and relatively accurate so that we can help from a planning standpoint. And, garbage in, garbage out. If we don't have good information, it's hard to give good advice. So if we can get good information, we can help give good tax advice and help implement good planning standards. After the first of the year, there's not a whole lot you can do with respect to the previous year's tax returns, other than maybe there's some opportunities retirement planning wise or something like that. But other than that, it pretty much is what it is by that point. So kind of goes back to the old saying, proper planning prevents poor performance.
Yeah, I'll just mention that from my broker, I got a note about a week ago or 2 weeks ago just saying, hey, be very careful about what you do with these type of contributions because you're getting really close to hitting another threshold in terms of taxes that you want to be very careful of. So talk to your tax advisor too.
Yeah, and that's the sort of thing I run into that as well, because sometimes people are making Roth IRA contributions or traditional IRA contributions, and they run into a situation where their income level prevents them from actually being able to make those contributions. Well, now you got to pull that money out. So again, conversation not just with the financial advisor, but also with the tax advisor.
Yeah. So it's been great again to talk to you, Kurt, and we really do appreciate all the work all the support you give to SCORE. It means a lot to the chapter, and quite frankly, our audience probably learns more from you about accounting and finance than they do from just about anybody else. So I want to thank you very much for all of that.
That's good to hear. I appreciate that.
Okay. So for our listeners, this is our last show of the year. We will be off on break for the next 2 weeks. And we come back in January with a full schedule of shows that we think you'll be looking forward to. You'll be able to hear a lot of different topics. We're already working on planning through some of those. So again, listen in. If you want to re-listen to this show or hear some of the older podcasts, you can either go to our website, biztalkwithscore.com. You can go to the SCORE Northeastwisconsin.org site, and you'll find a new landing page for our show with it on there. And you can go to iTunes and other podcatchers where you will find shows since the beginning of 2024 and going forward. So thank you very much, everybody. Thanks for listening. Have a great Christmas and a Happy New Year, and we'll talk to everybody next year.